Welcome to Market Monday from the investment team and the trust department at the First National Bank. We have quite a bit of consequential economic data coming over the next couple of weeks, and we're going to go through all that and what the implications are for the markets, and then talk about what's happening in equity markets, what potential drivers are there, and the same things regarding interest rate markets. So let's get started with the main event that's coming in a couple days later this week. The Federal Open Market Committee is going to make its rate decision, and we don't expect any change there, and neither does anyone else really in the analyst community. But what is going to be interesting is any changes in the language or messaging in the statement that comes out with that, because we are expecting that statement to become a little bit less definitive that they're looking to cut rates and more of indicative of their taking a wait and see approach that may leave the door open for them to resume a rate hiking cycle if that becomes necessary down the line. Quite frankly, we've been seeing quite a bit of economic reports that have come in much stronger than expected with regard to inflation. We had the consumer price index hot, we had the producer price index hot. We're going to talk more about those in a few minutes, but that is significant. We've had the labor market showing a lot of strength. The one-off here and there report has come in a little bit weaker, but in the context of a greatly increased productivity that we've been seeing, we're not really as worried about the economy slowing as we are that it reaccelerates and starts picking up steam again, which would cause the Fed to have to continue its rate hiking cycle. So we're kind of watching for what happens in their language, like we said, and that will be the most interesting thing that happens in the next couple of weeks. We'll get labor market information. We'll get information, these PMIs, the purchasing manager indexes, are sentiment indicators. Leading index. Now, the leading index is expected to show a 0.2% decline in the month-over-month basis, and that tends to indicate that the economy is expected to contract at some point in the not-too-distant future as opposed to continue to grow. And we are watching that. We've got quite a few consistent and consecutive leading index declines that have occurred recently that suggest that maybe the economy will be weakening in the near future. And that is a pretty good predictive index. So we do have our eyes on that, and we do think that there is a potential for a recession that only grows, quite frankly, if the economy continues to move in the direction that it's moving. We're going to get some more real estate market information, demand information in terms of durable goods, which is expected to show, a flip from a decline in the prior period to a growth. Again, durable goods, people are not buying big ticket items, or people in corporations are not buying big ticket items when they think that the economy is going to go sour over the near term horizon. So we're watching that pretty closely. Consumer confidence is another big one. The consumer spending is approximately 2/3 to maybe even 70% of GDP. And if that is growing, then GDP is growing. And consumer confidence telegraphs how likely consumers are to continue opening the wallet and continuing to spend, and therefore is a proxy for future demand and future GDP growth. We'll get information about the actual GDP. What was it in the quarter-on-quarter basis for the fourth quarter last year? This one is the last of the ones for the fourth quarter, and it's expected to show no change. And we also get GDP price index and the core PCE price index, where those are inflation indicators, although not quite as important as other ones that are coming later on in this period that we're looking at. We get sentiment, we get income and spending. This PCE deflator is actually the Fed's preferred method of looking at inflation over CPI, over PPI. They tend to look at this, and if this comes in hot, let's say this comes in at 2.6 or 2.8% annual, or instead of the 0.4 that's expected on this screen, it comes in at 0.6. That would be indicative of a resumption of inflationary conditions, and that would be a pretty clear call to action for the Fed to certainly not be lowering rates, but instead be looking to potentially hike them. So, we're watching that pretty carefully. If those numbers come in lower than expected, great. We're on track to see the Fed probably continuing to either tread carefully and stand pat, or potentially start rate cuts. So that number is going to be a lot more consequential than the 2 bars that Bloomberg is giving it. Going in, we get more information about sentiment, more information about demand, more information about outlook, and then the labor market to round things out. So that quite a bit on the menu for the next couple of weeks into the beginning of April. And I mentioned that the Fed is meeting, and that's just in a couple of days. One of the consequential items that they're going to give is called a dot plot. And we've talked about the dot plot on this segment, in this Market Monday, but we've never really illustrated it. So let's talk about what the dot plot is. That is a survey, or more accurately, the results of the survey of all of the different Open Market Committee officials as to where they see interest rates for a certain period. And we've put up here for 2024, this means each of these is the opinions, the collective opinions of the Open Market Committee as to where they think interest rates will be at the end of 2024, the overnight rate. And by doing this, you can see at each different meeting how this has grown over time in consecutive meetings, and then reached a peak over here where the median was 5 1/8 as of the September meeting, and then came down when they met in December. So when we're looking at the dot plot that comes out with this statement, with this rate decision Wednesday, we're thinking that there's a pretty decent likelihood that this thing will start to drift back higher again because of all of the somewhat inflationary data that's been coming to the market. If that happens, that's a pretty major market event. Markets will react to that because a lot of interest rates are based off of and tagged to the very short-term Fed rate. So if that's looking like it's potentially going higher, or at least not coming down, markets may have to adjust their pricing somewhat, and do that somewhat rapidly. So we may see some volatility based on that. If in fact it comes in and it's declining, then we might see this rally actually accelerate. So it's consequential whenever we get the dot plot. And as you can see, it's not at every single Fed meeting that we get it, but we do get it here. They will release it with the statement at 2 o'clock on Wednesday. Moving into equity markets, the S&P 500 has been on a tear for quite some time, since the end of October, and it's really wanted to do nothing else but go up. And people are asking why, is it sustainable, all sorts of questions. And the fact remains that when the market is going up on good news and not going down on bad news, that is a bull market. And it just seems that nothing can shake it, nothing can cause it to go down at this point. And we're going to continue to assume that the most likely line of least resistance, for lack of a better way to say it, is up. And so it's going to continue most likely to trickle up. But people are asking why. And here's one reason that we think might be contributing to it, or one thing that might be contributing to it. That is profit margins. So if we take the consumer price index, which is this chart here, and then look at it, it's growing. Consumer prices have been growing in the last period at about 3.2%. In fact, pretty much since the middle of last year, that's been around the rate of consumer price increases on an annualized basis. So we're going to proxy sales prices of corporations for the CPI. And then we have the producer price index, which is now growing by 1.1%. And that is obviously a good bit lower than the 3.1% that the consumer prices are growing at. So if we think of PPI as input costs to a corporation, the cost to sell a unit, and we think of the CPI as the actual sales revenue per unit, if the sales revenue is going up at the same time that, or by more than what the cost is going up, then the profit margin is going to be higher. Profit, of course, is revenue minus your costs. So obviously, if that profit margin is getting bigger, that means earnings is getting bigger, and ultimately stocks are priced as a discount of future earnings. If we want to boil it down to the essentials, obviously in real life it's a bit more complex than that, but it's a good enough answer for what we're talking about here. We'll end on the equity market for now by looking at volatility, which is actually since December trickling upward. And this VIX volatility index is basically a measurement of market participants buying protection from volatility in the market. And generally, when they're buying protection, they're buying put options because their volatility exposure to the downside is, in fact, when prices go down. Most investors are long investors. So when we see this 14.5, that's suggesting to us that the market sees roughly approximately 0.8 to 0.9% moves on a daily basis, and not much more. So it's basically placid conditions, but it's certainly a lot greater than, say, the 60 to 70 basis points of daily movement that were prevalent at the end of the year last year in December. So as we look to volatility starting to trickle up, that could be a telegraph that, hey, later on in the year we might see some volatility. And it's not unusual that when after the summertime comes, markets tend to get volatile in the fall. This might be giving us a little warning that, hey, that's going to happen this year. So we're on the lookout for that, and we are on the lookout for potential for choppy markets. We will go back now down here and look at corporate bonds, which the corporate bond curve, compared to where yields were even in January of 2023, they've come up a lot. So short-term yields went from 4 3/4 all the way up to basically 5.5 for 3-month paper. And this inversion of the curve just reflects the inversion of the Treasury curve, because corporate bonds are priced based off of the Treasury, and then they add another factor for the pricing of yield, what's required by an investor to buy this bond in terms of a payoff, and they add a premium for a potential default or credit risk premium. And that's because corporations could theoretically not follow through on their obligations. So you demand more than you would for the relevant Treasury, usually. And I say usually because and not always does that happen. Sometimes in times of financial crisis, things can become distorted. But in any case, we do not see a lot of credit risk in the market at all that justifies, this elevated level up here beyond a normal spread to the Treasury, what's been happening. So when we look at a corporate bond that's paying about 4.9% in 5 years, 5.2% over 10 years, those numbers are really, really good if you're a fixed income investor. And those numbers are really, really even better if you are a balanced investor where you own different asset classes and you have equities and then you have fixed income portfolio that balances and offsets some of the risk, because fixed income is a lot less risky. And now you're getting paid 5% or so in order to hold an asset that diversifies your portfolio and reduces the risk. So this is a really good situation for investors. And with regard to the Treasury curve, this curve is still pretty deeply inverted out to 5 years and then goes flat. And what is the story that this yield curve is telling us? Well, looking at things from the big picture, it says that the Federal Reserve is unlikely to do anything about rates within the next few months. And then it's going to be, rates are going to be coming down as risk in the economy recedes, but that we never get down to a level below around 4.5% on the Treasury curve. And with that type of a configuration, that's saying market participants see over long periods of time that inflation is likely to be elevated to, say, 3.5%, maybe 4%. Because let's look at the Treasury rate as a break even on inflation. Ultimately, investors own Treasuries because it's a quote-unquote risk-free asset. And what we mean by that is it's considered that the United States government will never default on its debts. Therefore, the only risk that's inherent in this bond is that which is due to inflation and the erosion of purchasing power. So if you're an investor, say on, let's call it 20 years, and you think inflation is going to be some certain amount, you're going to purchase these bonds all the way up until where that yield gets below or at what your inflation expectation is, and then you're not going to buy any more of it because you at least want to break even on the deal. So with that, we're looking at this as the bond market participants are among the most sophisticated and largest in the world, and they are only really looking at an inflation risk premium, and therefore they're looking at inflation rates remaining elevated for long periods of time. And I think that hasn't sunk in yet in the financial media, but the bond market is not lying about where people are positioned with trillions of dollars. So it bears watching, and it does suggest that we are in an era of secularly higher interest rates, and we'll have to keep attention to that, and we're okay with that. We're well positioned for that. Now, going back to the S&P 500, we're going to close like we always do with the big picture. because it's easy to get caught up in that spike that the market's been doing, and everybody's excited, and we think that this is either, the end of the bull market and it's got to end because it's gone on too long, or we think that, maybe it's going to go to the moon. All sorts of different views abound when the market is acting this way, and none of them are actually helpful. What's helpful is having a disciplined, long-term, well-thought-out plan that is executed, and, when markets are dropping like a rock, we're not panicking out, and when markets are doing nothing but go straight up, we're not getting overly excited and betting the farm. We want to keep an even keel approach. We want to keep the same approach. We want to absolutely at all costs avoid making decisions in a long-term plan that are based on short-term activities in the market or economy or politics or anything like that. So, hopefully you found this video useful. And if you have questions about your, portfolio, if you have questions about the markets, if you have questions about the economy and how any of this stuff intersects, feel free to give us a call. We would love to talk with you. And thanks. Have a great day.